Warren Buffett is sitting on $397.4 billion in cash, the largest pile Berkshire Hathaway has ever held. To most investors, that number looks like a flashing warning light, the same kind that lit up right before 2008, when the market fell and took a real chunk of the middle class down with it. If you are between 55 and 65, copying that signal with your own money is one of the more dangerous moves you can make. Buffett is managing corporate succession and tax timing on a scale of hundreds of billions. You are managing something far more personal, called sequence of returns, and it does not care how much cash a billionaire happens to be holding. Move to cash now because he did, and you could spend years watching inflation, running at 2.8% this year alone, quietly eat your buying power, while you wait on a crash that might not show up in time to matter. I've watched retirees make exactly this move right after a scary headline, then spend the next few years wondering why their neighbor's portfolio kept climbing, while theirs sat flat in a money market account. There is a way to hold your safe money that avoids that trap entirely. I call it the 5-year bond tent. It protects you from a real 30% drop in the market, without forcing you to give up the growth you still need to make your money last well past age 90. I will walk through exactly how to build it in a few minutes. If you are in that stretch of years, right before or right after retirement, and you are tired of headlines built to scare you into a decision, subscribe to Wes Investor. We build plans for real households, not for a company sitting on $397 billion in cash. There's a number that actually matters more than his cash pile. The total value of the stock market, compared to the size of the entire economy, sits at roughly 219%, more than 2 standard deviations above its long-run average. That is the real overvaluation signal analysts point to, and it is worth understanding because Buffett's cash decision and this number are not the same story, even though headlines love to blend them together. Buffett is not timing the market the way a retail investor times a trade. He is dealing with the size of his own company. With close to $400 billion sitting in cash and short-term Treasury Bills, he can only meaningfully invest in businesses worth $50 billion or more, and there simply are not many of those left at a price he considers fair. That is a size problem, not a fear problem. You do not have that problem. Your portfolio is small enough to move, rebalance, and adjust without shifting the market itself. The trap that actually wipes out middle-class savers rarely looks like Buffett's decision. It looks like this. Someone sees a headline, panics, and sells after the market has already dropped. Then they sit in cash through the recovery, because by the time stocks start climbing again, it still feels too risky to get back in. The damage isn't the drop. The damage is missing the years right after it. Run the real numbers, and this is what it costs. Say you have an $800,000 portfolio, and you move half of it, $400,000, into cash, because Buffett is doing something similar. The market bounces back 8% the following year, while your cash sits in short-term Treasury Bills, paying around 3.7%. That gap, 4.3%, on $400,000, comes out to roughly $17,200 in growth you simply did not get. You did not lose that money in a crash. You gave it up trying to avoid one that had not happened yet. I used to think copying what the biggest, smartest money in the room was doing had to be the safest move available. Then it clicked for me that Buffett is working with something close to a 100-year time horizon for a company built to outlive him. You are working with something closer to 30, and every year you sit out matters a lot more to your number than it does to his. So if the market really is stretched, sitting at 219% of GDP, how do you protect yourself without parking everything in cash and giving up years of growth? That answer is not something Buffett needs, because his size makes it irrelevant to him. For someone your age, it is the whole game. Forget copying Buffett's cash percentage. The 30% he is holding means nothing for your household, because your spending has nothing to do with the size of Berkshire Hathaway. What matters is a single number: how much cash you actually need to cover your life if the market goes quiet for 5 years. Finding that number starts simple. Start with your annual spending. Say it comes out to $80,000 a year. Subtract what Social Security already covers, which for a lot of couples lands around $30,000 a year, combined after this year's cost of living increase. That leaves a net gap of $50,000 a year, the amount your portfolio actually has to produce. Now take that gap and multiply it by $50,000 times 5 years equals $250,000. That is your bond tent, the amount you hold in safe, liquid assets like Treasury Bills and short-term bonds, sitting completely outside the stock market. A flat percentage, like the 30% Buffett is holding, does not know anything about your life. It does not know your mortgage is paid off, or that you are still 5 years from Medicare, or that your Social Security check covers more of your bills than your neighbor's does. Your tent number is built entirely from your own numbers, which means it flexes with your actual situation, instead of copying a strategy built for a company worth well over $1 trillion. 5 years is not an arbitrary number. If the S&P 500 drops 30% tomorrow, you do not touch your stocks. You do not sell a single share at a loss. Instead, you spend directly from the tent for 5 years, which gives the market room to recover, before you ever have to pull from a beaten-down account. This is what protects you from something called sequence of returns risk, where the order losses happen in matters more than the average return over your whole retirement. Hold too much of your money in that tent for too long, though, and you trade one risk for a quieter one, the cost of money that never gets the chance to grow. I was talking with a couple last week, let's call them Jim and Sarah, out in Ohio. They were putting off retirement because of all the Buffett headlines, worried they would retire straight into a crash. Once we sat down and built their actual tent number, something shifted. They knew their grocery money, their insurance premium, their property tax bill, all of it was covered for 1,825 days, no matter what the Dow did on any given morning. The fear didn't disappear because the market got safer. It disappeared because their plan did. This is the part that gets missed when people copy Buffett instead of building their own number. He is protecting a company. You are protecting 5 years of groceries, a mortgage or rent payment, and whatever insurance premium shows up every month regardless of what stocks are doing. Those bills do not pause during a downturn, and neither should the plan that covers them. But a 5-year cushion assumes the recovery happens inside 5 years. What if it takes longer than that? The 2008 crash didn't fully hand back its losses for a while. And if you are building a plan meant to last 30 years, you need to know whether 5 years is actually enough runway, or whether you are just pushing the same risk a little further down the road. The number everyone remembers from 2008 is the crash itself. The number that actually matters is how long it took to come back. Including dividends, the S&P 500 needed roughly 5 years to fully recover what it lost. That is close to the 5-year tent we just built, which is exactly why the tent exists, not to dodge a downturn forever, but to outlast the worst stretch on record, without forcing a sale. But here is the piece most retirement plans miss entirely. You are not actually planning around a 2-year crash or even a 5-year one. According to the CDC's most recent life tables, a 65-year-old man can expect an average of about 18.2 more years ahead of him, putting him around age 83. A 65-year-old woman has closer to 20.7 more years ahead of her, putting her around age 86. Some of you will live well past those averages. That means you are not planning for a bad quarter. You are planning for a 30-year journey that has to survive several of these downturns, not just one. This is where copying Buffett's cash percentage quietly turns into a different kind of risk. If you hold too much in cash for too long, the way a company managing hundreds of billions can afford to, your money stops growing fast enough to keep pace with your own rising costs. Medicare Part B alone runs $202.90 a month in 2026, and that premium has climbed almost every year for the past 20 years. Multiply that by 12 months, and it already runs past $2,400 a year. Before you add in supplemental coverage, dental, or the property tax bill that rarely goes down. None of those costs care whether the market is up or down that particular year. They show up regardless, and they tend to grow a little every year you are alive to pay them. Sit in too much cash for too long, and you are not protected from risk. You have simply swapped market risk for a quieter one, the risk of running out of money at 85 instead of 95. So the tent has to actually work, which means it has to sit somewhere that keeps pace, without exposing you to the same volatility you built it to avoid. That is not a regular savings account sitting at your local bank. It is something more specific, and the difference between the two ends up mattering more than most people realize. Not all cash is the same, and this is where a lot of the bond tent falls apart in practice. The cash sitting in your checking account, earning close to nothing, is not the same tool as a Treasury bill, even though both get lumped together under the word cash in casual conversation. A checking account is for bills due this month. A Treasury bill is a loan to the federal government that pays you interest for a fixed window of time. And short-term Treasury bills are currently yielding close to 3.7%. Building the tent in practice looks like this. First, calculate your net gap, your annual spending minus whatever Social Security and any pension already cover. Second, move about 2 years' worth of that gap into a money market fund, something liquid enough to reach in a few days without penalty. Third, take the remaining 3 years and build a ladder of Treasury bills, staggered across 3-month, 6-month, 9-month, and 12-month terms, so a piece of the tent matures on a rolling basis instead of all at once. There is one more piece worth knowing if you spent years working in a school system, a police department, or another government job. Since the Social Security Fairness Act repealed the windfall, elimination provision and government pension offset, a lot of former teachers and public employees are now receiving a full Social Security check instead of the reduced one they used to expect. If that applies to you, your net gap just got smaller, which means the tent you need to build got smaller too, sometimes by tens of thousands of dollars compared to what it would have been a couple of years ago. None of this requires anything exotic. It requires knowing which bucket your money sits in and matching that bucket to when you will actually need to spend it. But even with the tent built correctly, sitting exactly where it should, your instincts are still going to fight you. The next time a headline says Buffett is selling everything, that reaction is worth understanding on its own, because it is not a character flaw. It is just how the brain is wired. There are two biases doing a lot of work here, and it helps to name them. One is recency bias, which makes the last big crash you lived through feel more real than the decade of gains that followed it. The other is loss aversion, which makes losing money hurt roughly twice as much as gaining the same amount feels good. Put those two together, and a headline like Buffett is selling everything is almost engineered to grab you by the collar. That pit in your stomach when you see a headline like that is not a character flaw. It is closer to an old survival instinct doing exactly what it was built to do. Treat a possible threat as urgent, even when the threat is still just a headline. Feeling it does not mean you are bad with money. It means you are paying attention. That instinct kept people alive for most of human history by treating every sudden threat as urgent. It was never built for a stock ticker, and it cannot tell the difference between a real emergency and a headline written to get clicked on. Sit with this reframe for a second. Buffett is not selling because he is scared. He is selling and holding cash because he is disciplined, following rules he set for himself long before this quarter's headlines existed. You can borrow that same discipline without touching a single share, simply by rebalancing on a schedule, instead of reacting to a scroll through the news. Rebalancing means trimming what has grown into too large a share of your portfolio and adding to what has fallen behind, on a calendar you control, not on a headline's timeline. If this logical approach makes more sense to you than the doom and gloom headlines you see everywhere else, hit subscribe. We build plans around your own numbers here, not a billionaire's balance sheet. Buffett's $397.4 billion says something about the size of Berkshire Hathaway. It does not say anything about your household, and it was never meant to. The signal that actually matters for you is the one you build yourself, a 5-year bond tent that covers your real spending, protects you from selling stocks at a loss during a downturn, and still leaves the rest of your money invested and growing. You spent close to 40 years building what you have. A billionaire's tax and succession strategy should not be the thing that decides how calm or anxious your retirement feels. The market will still have rough years. That was always true, with or without $397 billion sitting on Buffett's balance sheet. Retirement is not one decision you get right or wrong on a single day. It is a string of smaller, steady choices about where your money sits and why, and the tent is simply the first one you now get to make on purpose instead of out of fear. Build the tent, protect the years right around retirement, and let the rest of your money keep doing its job. Stay invested, stay protected, and I will see you in the next video.